So we'll start by talking about debt. We've done a little bit of talking about debt. We just had a chapter on valuing and estimating the cost of debt, so this shouldn't be anything new to you guys. There's tons and tons of different kinds of debt. There's, just to name a few, we got commercial paper, which is really, really short-term debt, like overnight debt. Notes payable, which is 30 to 60 days. Fixed and floating bank loans, which are 6 months to 10 years probably. Corporate bonds, which run the full gamut, all the way up to 100 years. And then any kind of capitalized lease arrangements. So we have to value each of these types of credit, each of these liabilities. We want to know, we need to subtract the value of the claim they have against the firm before we can estimate the equity value. Okay? So if we have investment grade debt, so these are publicly traded bonds, and it's actively traded, again, we talked about some of the issues there, we can use the market value. So we can go look at the bond price, multiply by the number of outstanding bonds. That is the total value of the debt claim against the firm. We subtract it. If it's privately held debt, meaning, and this is pretty common, the firm sells an entire bond issue to, say, like a private equity fund or another big company, like an insurance company like Berkshire Hathaway. So it's private, it's investment grade debt, but it's not publicly traded, meaning we can't estimate the market price. What we need to do is look at the contract and then take all the present value of the future payments that we're going to have to make, discount those cash flows at the yield to maturity on our that we've estimated for the firm, and that's the current value. Then we can take that, multiply it by the number of the bonds that are owned, and that's the value of the market value of this debt, and we subtract it, right? Remember, we can never use book value here because interest rates and default rates, they've changed since the bond was issued, presumably, unless it was like a week ago. So we need to estimate the market value, and that's not always an easy thing. Right? For distressed companies, again, I'm sort of going to leave off this talk about distressed companies and how that looks. I didn't talk about it in the bond chapter, so I'll leave it off here just in the interest of time. But it's a little more complicated, so it's just we don't have the time to cover it anymore. Right? So I'll cut off this, but we do have a valuation approach that has to be different if the company has a lot of debt and is in financial trouble. Okay? And then operating leases, right? This is, we talked a little bit about this. I used to go into more depth, but actually some accounting rules changed in the last 3 years that made operating leases not as attractive to firms anymore. But essentially, again, remember, an operating lease is something that is an asset the firm used to have that they then sold and now lease back from someone else. And that means that they are able to take the asset off the balance sheet. But more importantly, they take the liability that they used to pay for the asset off the balance sheet. So if I had a loan that I used to buy an airplane, and then I was paying off that loan, I had the loan on the liability side, I had my airplane as an asset, and then I had interest expense on my income statement. And then I had whatever revenue I was generating from the airplane in my revenue, and costs of maintaining the airplane and all that stuff on my income statement. An operating lease means I sell the airplane, I use the money to pay off the loan, both the asset and the liability go away. So does the interest income. Then I lease that back. And so still on my income statement is going to be revenue and maybe maintenance costs depending on the loan, but maybe not. If I have a lease where I don't have to maintain the airplane, then I don't even have maintenance costs. So I just have revenue and then I have rental expense left. Right? This is kind of misleading because the company still is effectively paying a loan. Right? This is still almost exactly the same thing as a loan, just isn't called a loan, and so we don't have to treat it like a loan on our financial statements. Now, what we talked about when we did a DCF and we rearranged NOPLAT and invested capital is we actually tried to identify any of these operating leases and we tried to put them back on the balance sheet and the income statement as if we still owned it and still had a loan, right? This is called we call this reconciliation to the balance sheet and the income statement. We try to go backwards and say, okay, if I still had the loan for the company, it would look like a liability here. And I would have the asset for the plane here. And I would have the interest income here. Like I tried, when reorganizing the balance sheet and the income statement sometimes means putting in financing items or financial items that actually don't exist. And it's just so that we can get an accurate picture of the company's operations. Okay? So if I've done all that correctly, I've included it in NOPLAT and invested capital. I also am then going to have to treat this just like any other kind of debt. And so when I subtract the value of the debt claim, I need to subtract the value of the operating lease claim from enterprise value, because it is still a claim against the firm. If I don't pay this back, they can come after me for the value of that contract, just like a loan, right? They already own the asset, so they can't come after me for the asset. They can remove my use of the asset and then come after me for the remainder of the contract. That's why we think these are debt equivalents, because they look and act just like debt. And we'd like to treat them like that when we do our valuation. Okay? Now again, I don't talk about this as much as I used to, because accounting rule changes have meant that it's not as attractive for firms to do operating leases. In fact, some accounting rule changes make the firm itself capitalize it on the balance sheet, and then that removes a lot of the perceived benefits to firms. Because one of the perceived benefits is that if you get rid of a lot of big assets in favor of operating liabilities, it can really increase your return on invested capital, which just makes the firm look like it's doing better. Okay? So if we've done that, we need to also include this as debt, and we need to subtract the value on our way to equity value. Okay. If we've got any unfunded pension liabilities, again, I used to normally would have a short chapter on this. Again, we just don't have time, so we'll leave off. But essentially, an unfunded pension liability means that I owe my pension plan for my employees' retirement money that I haven't paid, right? I have actuaries every year calculate the total amount of money that needs to be in the pension plan in order to pay all of the retired employees and all of the future employees that haven't retired yet their full pension payments. Right? So it's a very complicated process. Actuaries are really well paid. If you like math and you like this kind of stuff, I highly recommend it as a job prospect. But essentially, you're estimating how long the employees are going to live, so that means how many payments they're going to draw down. Use all of that information to calculate how much money should be in the account. An enormous amount of firms are drastically underfunded relative to that value, right? And you can see here, this is DuPont. They're a big chemical company. Just look at the last year, 2007. Their funded status up at the top says negative 3.7 billion. Right? That means they owe their pension plan, according to their own actuaries, they owe their pension plan $3.7 billion in order for it to be able to completely provide payments for their retired and retiring employees. This is pretty common, but it's a claim, right? This is a claim the employees have against the firm. The firm has promised them retirement benefits in these amounts, and the firm must provide this money to the employees. Otherwise, it's just like any other loan, any liability. The employees can come after the firm for this kind of money. So this is money this is part of the value of the firm that's promised to employees. And so before we get to equity value, we have to deduct this liability. And then we got some other kinds of debt equivalents, what are typically called provisions, the operating provisions and non-operating provisions. So long-term operating provisions are things like decommissioning costs, restructuring charges, these kind of things. They're typically, the balance sheet has a reasonable approximation of what these liabilities are. Right? So these are just listed as liabilities. It says long-term operating provision, negative 100 million. And that just means we are estimating that we have $100 million over the next 5 years associated with decommissioning a plant or cleaning up a hazardous spill or something like that. Or we're restructuring the balance sheet, and so some of these liabilities is severance payments to employees. Right? And then we have contingent liabilities, which is typically associated with something like pending litigation, meaning somebody sued us and we owe them money. Right? And so we are going to take the after-tax cash flows of what we think these payments are going to be, discount that at the cost of debt. So let's say I think I'll have to pay based on this being sued and the outcome of this lawsuit, I think I'll have to pay $10 million a year for the next 5 years. I discount those promised payments at the cost of debt, the yield to maturity on my debt, and then the present value of those payments is the value of this liability that I need to deduct from enterprise value to get equity value.